viewers, welcome to the video lecture series for job role of Solanaceous crop cultivator class 10th. In continuation to the video of session 1 of unit 5, that is basic farm management, we shall be covering the third part of the first session, that is farm management and selection criteria of vegetable crops. In this video, we shall learn about financial management at a farm, different categories of costs at a farm, and record keeping at a farm. So viewers, now let us begin by understanding the most important concept of farm management, that is the financial management. Financial management is concerned with productivity, that is use of and income from production resources. Specifically stated, the production economics includes combination of farm enterprises, methods of production, size of farms, returns to scale, leasing, production possibilities, farming efficiency, use of credit and capital risk, and uncertainty which affects decision making. First of all, let us understand the cost of production. The cost refers to the total amount of funds used in production. The nature of production and the prices thus determine the cost structure. Cost of production involves both cash cost items and non-cash items. Cash costs are when resources such as fertilizers, fuel, oil, casual labor, etc. are purchased and used immediately in the production process. Non-cash costs consists of depreciation of farm implements, equipment, buildings, etc. and payments made to the farmer themselves or family labor management and owned capital. So what are the different categories of cost? Viewers, several kinds of costs are involved in even the simplest production process. First, fixed costs. These are those that do not change with the amount of output and are incurred even when there is no production. Fixed cash costs include land taxes, interests, insurance premiums, annually hired labor, permanent labor, electricity charges, etc. Non-cash fixed costs include depreciation on buildings, machinery, interest on capital investments, cost of family labor, and cost of management. Variable costs. These are the cost of using variable inputs. They vary with the level of production. The higher the production, the more will be the variable costs. It includes items such as seeds, fertilizers, casual labor, insecticides, fuel consumption, etc. Total costs. It is the sum total of fixed costs plus variable costs. Total costs are required for computing net revenue. Net revenue is equal to the total revenue less total costs. During the planning period, all inputs are variable. Viewers, apart from the financial management, record keeping is one of the major tasks to be performed by a farm manager. Farm record keeping is the art and science of recording various farm details and business dealings in a regular and systematic manner so that their nature, extent, and financial effects can be readily ascertained at any time of the year. So, what are the advantages of maintaining a farm record? Viewers, maintaining farm records have many advantages. Let us understand them one by one. First, means to higher income. To obtain higher income, farmers must have exact knowledge about the present, potential gross income and operating cost. Second, basis for diagnosis and planning. Diagnosis of management problems is the prerequisite of sound planning. Data and accounts provide the necessary information needed for such a diagnosis. It is also a way to improve the risk-bearing ability of a farmer. Third, basis for credit acquisition and management. Properly kept records and accounts can demonstrate and authenticate the production and income potential and creditworthiness of the farmer. Fourth, guide to better home management. Records and accounts provide information on the farm household economy. This is particularly important in Indian conditions where the farm and home management are so closely integrated. It is the basis of research conducted in agricultural and production economics. Fifth, basis for government policies. Various state and central government policies such as land policies, price policies and crop insurance etc. need a farmer's feedback for their more practical viability. That is, when these records and accounts are helpful in obtaining the correct data for examining and developing sound policies. Viewers, let us now understand the different types of farm records. The farm record system has three parts: physical farm records, financial farm records, and supplementary farm records. Physical farm records. These are related to the physical aspects of operations of a farm business. The records include map of the farm, soil and contour etc., preparation of charts on physical efficiency, records on utilization of land, records on crop production and disposal, daily work record diary, labor records, machinery use records, stock register etc., and casual and hired labor records. The financial farm records are mainly related to the financial aspects of the operations of a farm business. The records include farm inventory, farm cash account or farm financial accounts, classified farm cash accounts and annual farm business analysis, balance sheet for net worth statement. Supplementary farm records include capital asset sale register, cash sales register, credit sale or purchase register, wage register, funds borrowed or repayment register, farm expenses register, and non-farm income record. So viewers, we have come to the end of this session. Let us quickly recapitulate the contents of this video. In this video, we understood the concepts of financial management at a farm, different costs at a farm, and record keeping at a farm. Thank you.